The simplest form for value creation for an activist is a quick transaction that comes out of it. So over the last 10 years, when you had rates that were at 0%, when you had multiples that were only going up, and you had this enormous private equity and dry powder that was available from a supply perspective, which meant that there's still paucity of assets available in the market. It was a simple lever for an activist to take a small stake and catalyze some sort of M&A trade, provide a quick, simple exit from a premium perspective, which all shareholders supported. Today, the environment, as we all know, is much more tricky. Private equity still remains largely on the sidelines. Rates are higher, which means to solve for I don't know if it's 20% IRR, 25% IRR through investment committees, it's much more difficult because it's harder to imagine an environment where you're solving for 7% interest rates with a potentially degradation in multiple at exit. That makes the math much more difficult. Listen, activist tactics have certainly evolved. If we just look in the US, 20 years ago, 15 years ago, if we take a real step back, activists had to be public. They had to go to the media and catalyze the ethos of the investor community to cultivate a potential sway into their ideas. Because ultimately, it's a tactics and it's a war of ideas. Today, what you've seen is activists are a lot more private because they realize we don't need to be loud, we don't need to be nasty and short with companies, because ultimately we're long investors. We're looking for long-term value creation, which is what all investors want. So we can remain much more private in our engagement with companies. And as advisors, we've certainly seen the behest of that. What's changed in today's landscape is when you can take a position in a large cap or a mega cap name, there's multiple quivers that you can push to unlock that asymmetry value. There is that core aspect of, can we break up the business and focus on a spin-off, a divestitures where you may potentially not require an M&A partner, or have some of these large companies grown at all costs and they've forgotten a little bit from a cost perspective and been disciplined around free cash flow margin and costs. And what you've seen is in the last 12 months, many companies have gotten in front of that and pushed for real focus around cost and margin takeout. Activists like this playbook. Second thing that I would say is, just like the broader market, there's this big focus around the Magnificent Seven or the mega caps and the mega fives of the tech assets, and that's really driven a significant portion of the market. Activists are value investors. For some of these situations and some of these portfolios, companies that they own, it may just be a value play, or it could potentially be an activist strategy down the road. That's something we're potentially starting to see, where there's a lot of private engagement from the activist community within these large cap, mega cap tech names, where previously it was very difficult to invest from an entry perspective, given where the valuations were. But as the asset class has grown amongst the Magnificent Sevens or the top 5 companies within the S&P 500, activists are also screening for them from a position, from a value play. I generally don't view activism product as a defensive product. The way we think about it is, what are strategies that we should be doing as good governance and good stewards of capital to unlock this asymmetry of value? That's what CEOs are thinking about every awake hour at their company. How do I increase EPS? If I increase earnings per share, I increase the share price that creates incremental shareholder value. Activism is just a maneuver to unlock potentially this asymmetry of value. And activists are long-only investors. They want companies to do well, they want CEOs to do well, and frankly, they want other shareholders and themselves to have a successful exit, successful outcome. What the difference potentially sometimes lies in is the plan B or plan C an investor provides that misaligns with company strategy. So that's when the war of ideas comes into play. So from a preparedness perspective, it's less about what are the walls I can put around the company. It's more about what's the right thing that I should be thinking about constantly. And that's what we focus with a lot of our clients is, what are maneuvers that we should be thinking about from an organic perspective? Where should we spend our R&D? Where should we spend our CapEx and investment opportunities? And if there's potentially a transactional element to it, whether that's a potential capital structure maneuver or M&A, divesting assets, buying businesses, increasing our growth potential, that's what we should be doing. And that's the work that we're focused around. then activists and potential investors that are coming at you is a bit of an output rather than an input.